Hey everybody, my name is Allison Ostrander and I am the Director of Risk Tolerance here at Simpler Trading. And in today's video, I want to talk about understanding risk and specifically in regards to options trading. So let's dive into the video. First and foremost, what is risk, right? Well, to put it simply, typically risk refers to the capital amount you have the potential to lose whenever we're talking about trading, right? So if you put on an options trade and you're, of course, taking capital from your account to put that on, that capital that it costs to put out that trade idea is usually referred to as your risk, right? The risk that you have on a trade. But there are different types of risk with options trading. And so I want to make sure to address some of these risks so that way, whenever you might be listening in to another trader and they're talking about these different types of risks, you have a good grasp of what they're referring to. And so the four types of risks we're going to cover here are directional risk, volatility risk, time decay risk, and the risk, of course, of early assignment. So let's start off with directional risk here. Directional risk involves the potential loss if the market moves in the opposite direction of what the trader anticipated when they first put out a trade idea, right? Directional risk can arise from the trader's expectations of the market's direction, right? And a trader might have a bullish thought of the market or of a chart, right? Thinking that it's going to move upwards. They might have a bearish bias, thinking that the market or the symbol that they're tracking and trading is going to move downwards, or even a sideways direction. And that directional risk basically pops up when, for example, a trader might be thinking the market's going to go up and it actually instead goes down. So that's directional risk. There's also volatility risk, of course, right? That's the second type of risk. If volatility increases, option prices may rise, potentially resulting in profits for the option holders. A decrease in volatility may cause option prices to decline, potentially resulting in losses for options holders. Now, this, of course, is very dependent on the option strategy you're trading. If you're trading a long call or put when volatility is high and then that volatility decreases, that's where you might find yourself with a potential loss. Whereas credit spreads, a different type of option strategy, sometimes benefit when volatility decreases to take in a profit. So make sure you're understanding what type of option strategy, of course, you're putting out there and see whether or not it benefits from volatility increasing or if it benefits from volatility decreasing, right? And both of those refer back to, of course, the risk around volatility itself. Options with higher volatility are more sensitive to price fluctuations, while options with lower volatility are less sensitive. Option spreads, such as vertical spreads or calendar spreads, can help mitigate volatility risk, right? And as I mentioned earlier, there are some strategies like credit vertical spreads that can actually really benefit from the decrease of volatility, whereas a long call or put might benefit from that increase in volatility. If the market moves, of course, in the opposite direction to what the trader anticipated, it can result in losses. And that, of course, refers back to that directional risk that we talked about a bit earlier. Time decay risk. Well, options, of course, have a limited lifespan, right? That's why we have expiration dates around them, typically ranging from either days to months. Or, of course, if you're trading something like SPX, you can even have same day expiration and that risk of time decay. As the expiration date approaches, the time value, which is the extrinsic value, right? That's what it's sometimes referred to as, of the option decreases, right? The less time you have until expiration, the less probability that the underlying price can move either in or against your favor. And either way, that chips away at that extrinsic value because you have less time value on the trade. This is primarily because the probability of the option ending up in the money decreases with less time available for the underlying asset price to move favorably, right? And once again, this will depend on the option strategy you're trading. But in general, if you're trading something like a long call or put, especially if it started out of the money, then you need to be very mindful of how expiration comes about, right? The closer it gets, that time value, that extrinsic value is going to decay away. And that can certainly hurt a strategy like a long call or put that is out of the money. If the underlying asset's price remains stagnant or moves unfavorably, the option may lose value even if the stock price doesn't change significantly. Certain option strategies, such as spreads, straddles, and strangles, can help offset the effects of time decay. And once again, it depends on what kind of strategy you're doing. So, on spreads, for example, specifically credit spreads, once again, can be a beneficial to the decay of that time value, right? Of that extrinsic value. Because ideally, on credit spreads, you want them to be out of the money, worthless for you to receive a profit. And for those of you who are not familiar with credit spreads or need a refresher, please feel free to go back and watch the video around credit spreads to get a better idea of what that is. We then, of course, have the risk of early assignment, where an option seller is assigned an exercise notice before the expiration date of the option contract. Early assignment can happen when the option holder believes it is advantageous to exercise the option early, potentially due to significant changes in the underlying asset price or because of other market conditions. Before we move on here, let me just point out though, early assignment is not very common, at least in my experience, right? And I'll tell you about that. So, the only times I've ever been assigned in general with trading options was twice so far in my entire trading journey. And one of those times was because I actually held the trade through the expiration, right? Through the close. Uh, and it was on SPY because in my head, I was thinking it was a cash settled option like SPX. And it slipped my mind that SPY technically has shares. And so when I held it through the expiration, I had that risk of assignment. But early assignment, I have found, is really rare. And I have been early assigned once in my entire career, and that was on CMG. And this was years ago. I mean, this was well over 10 years ago, like at the probably closer to 15 years ago now, closer to the start of my trading journey. And when that early assignment happened, it was because the spread was in the money, or it was starting to go in the money. And so the person, the option holder, right on the other side of my trade, exercised that option Thursday going into the Friday expiration. So it happened overnight Thursday going into Friday where that early assignment risk occurred. So in my experience, it doesn't happen very often. And when it does occur, it from my experience and with talking with other traders, it usually happens going right into the expiration itself. So just something to be mindful of. Not very common, I would say, at least, like I said, from my experiences with trading options for as many years as I have, but there is still that possibility. So, of course, as a trader, it's something that we want to be aware of and mindful of. So, when you have a good understanding of capital risk in regards to your account, as well as your individual trades, you're setting yourself up to succeed rather than be defeated by the dark side of trading. So, as I mentioned, there are different types of risks to be mindful of. The first and foremost, I would say, is having an understanding of the capital risk that you're putting out there. But it's good to also know in options the idea of directional risk, volatility risk, time decay risk, as well as the risk of early assignment.